And welcome back to another YouTube video. In today's episode, we're going to be really clarifying why retail trading doesn't work, and in the format we're going to be doing that in is trend lines, right? Trend lines, one of the most popular beginner traders strategies when they first come in, like, hey, how do I trade Forex? One of the first things they're going to stumble on is this trend line strategy or this EMA or Fibonacci or whatever. But today we're going to show you exactly why trend lines don't work, and we're going to give you the logic behind why they don't work, and instead how to actually use a trend line, right? And you're going to be shocked. So you're going to want to stay the duration of this video to really understand why it is we're getting at. So let's get straight in, right? I mean, for the purpose of this video, I'm going to start on the line chart, as I usually do, in all honesty. Let's say price is in an upward direction. Right, now we can see prices in an upward direction, right? And so in such a scenario, I mean, maybe it's an even deeper trend line. Sometimes it's quite literally a very steep trend line. Trend lines come in all variation of degrees. But the point is price is seen to be trending in such a way. Right, and now what this trend line represents is a lot of the strategies out there are, okay, when price touches on the third go, I'm going to get in and I put my stop loss, just below the trend line, because if it breaks, then the trend is finished, and then I'll be actually looking for shorts. That's one type of trader. And then the second types of trader are the types of trader that are like, hey, when this trend line breaks and closes, for example, I'm going to short and I'm going to just put my stop loss just above, and then I'm going to sell. Right, so there are both sides of liquidity. There are the buyers and the sellers. The buyers are predicting price continuing in its trend. The sellers are continuing the trend has reversed. So with that understanding, we know that there is considered liquidity, which essentially just means positions available for the banks and institutions, or for the algorithm, or just genuinely money, right? So a lot of the times what you'll see is these entries get triggered. Price taps in one set of traders and pretty instantly taps them out, because usually we break to a varying degree. And then as we do that, we also tag in the sellers, and in such a way continue to make a new high. And what you'll notice is we don't actually break the swing low, right? And this is where a lot of retail traders get trapped, is because they understand the direction is bullish, but they don't understand that this can still be a swing high and a swing low, and this can be your interior structure. So they don't really understand the different types of structure. They just think one time frame on one structure tells the whole story. But when you understand the fractal nature of the market, that becomes a very different understanding. If understanding the fractal market is something you do want to understand, then we do have other videos on this YouTube channel that explains what fractals are and how to use them in regards to order flow. So here's the trendline scenario that we've just gone over, right? Now, let me take this concept and paint this picture on a real market for you. So as we can see, any trader that's been looking at this type of chart, they're going, oh, that's very much a trend line. Price is trending higher. It's making higher highs, higher lows. And they are thinking on this third line trend touch, they're going to take a trade, and that trade, because it's trending, is going to, I don't know where traders put their stop losses these days. I mean, okay, let's just call it below this low, right? Let's say they put their stop loss below this low, and what are they trying to take out? They're trying to take out these highs. Why? Because it's structure. Structure is supposedly bullish. So that's how a retail trader who may trade a trendline strategy may be looking at the market. Whereas I, for example, am looking at this quite differently. I am perceiving this to be liquidity, because I already know that there are varying degrees of retail traders that are getting involved in this market. So there are traders who are going to short the market, when we actually break the trend line, with their stops probably just above here, and then they're going to be traders that long the market. So we know there are two types of traders, as just discussed. And now I purposely am looking at this right here as more of a liquidity. And the reason is because you actually zoom out and you understand the higher time frame banks, order flow, and tension. Well, what you can really see is that order flow is overall bearish, and we are likely to go and put in lower lows when that gets confirmed. Now, to me, that becomes confirmed because you can see that we tap into a higher time frame supply range, and from that higher time frame supply range, we have our sweep of liquidity. When we take out the high only with a wick, that is our sweep of liquidity, and then you can very clearly see in which point we actually change character. Now, the level that changed character, as you can see, has already been mitigated. Right here, we have changed character, come back up, mitigated, and then continued. So from the level of continuation, we have this level. And because order flow is bearish, I would be more interested in looking at something along the lines of taking a short from levels in here and taking out the stop losses in and around these levels. Now, of course, we don't trade this time frame. We trade with more confluence also than just this. Like a 1 to 4.85 would never satisfy us. It's a minimum 1 to 5. Minimum 1 to 5, very rarely a 1 to 5, but a minimum of a 1 to 5. And just taking our take profit directly into the liquidity, which is this person's stop loss liquidity, right? And if you just play price, you'll see, okay, the first trader has been tagged in and give this wonderful quote unquote reaction. Now, whether that trader stays in or not is debatable. Let's just say he does for the purpose of this video and say he doesn't actually break this low, and that's where his stop loss was. Well, now we've added more liquidity because now we've added a level of support, right? More retail liquidity. Support or resistance or whatever you want to go ahead and call it. The point is that now is essentially more liquidity to take. So my position could even go down here now into deeper liquidity, taking out these lows. So I know it's getting pretty confusing because there are many different traders. So this trader right now is in his trade. Let's just say he stayed in. And we just play price out because, as you can see, like we have broken through the trend line, but they might have protected lows or whatnot, which is another thing. So these traders are in positions right now and they're running in positions. And if they didn't, when price is pushing up, that's going to induce them to buy because price is quote unquote having a reaction to that key level, which it's not. It's just a form of liquidity inducement, right? And there you go. So those traders get taken out very quickly. Now, those traders are taken out. What does that mean for us? Does that now mean that our trade isn't still on? Well, no, because there are always different forms of liquidity. This is a new form of liquidity. Traders now think price is going down from this level right here. That's liquidity, which enables the further support of our trade idea. And we can just take it into whatever low that essentially gets formed. And it tags us in again and again. And essentially price plays out this one long delayed thingy. Now, what does this do, right? This is all now liquidity because price is very compressed, which means all of these orders are mitigated, a different type of liquidity that I will make a different video on. But you can see that all of that essentially is liquidity, and all of that liquidity has now been taken, right? Price comes back into our entry level. We haven't yet hit take profit, but what have we done? Well, we've built more liquidity because now we can see a new trend line, quote unquote, forming, right? Price is making highs again. There's a chance that price could come and tap this and go higher, right? Retail trader thinking. Well, that just adds more liquidity to us, which adds more of a reason for price to continue going down in that manner. So as you can see, price does hover around for a good while in our order. Had, again, you had been taking this trade, which we don't, by the way. This is part of our strategy. The most important thing is that we understand that price was going to react from this gray box and probably going to take out this low. That's the piece of information that we know. Now, taking this trade exactly, we would actually be taking this on a lower time frame with different confirmations, etc. But just for the purpose of this video, which is to show you why trend lines don't work, we thought this would be enough. You can see price really consolidates and ranges, and what does that ranging do? It builds more liquidity, right? So again, essentially we are just creating a lot of liquidity, which eventually all gets taken, right? Because now the trend line has been broken through. So what does that trend line do, right? If you actually visualize this as we just did it, it took the trend line out, which took the stop losses out, but it didn't just take stop losses of the buyers out, it also put the sellers into positions. Because when that level broke and people were selling, well, where would they have the stop losses? They're not gonna have the stop loss all the way above here, right? They're gonna have the stop losses somewhere in here, and they're gonna play the retest and then try to continue. And as you can see, it takes both sides of the liquidity out. There was always two sides. There was the liquidity and then there's the inducement. And they're very similar, but one is essentially where the stop losses are and one is where the entries are. And then you can see very much so that our orders get taken out. Now, could I have taken out this low down here? Yes, because of order flow, right? Essentially, the flow of orders from the institutions are flowing to the downside. And if I was to go to, let's say, a higher time frame for whatever reason, on the daily, for example, we would understand that there are lows down here, right across here on the daily time frame that are being mitigated or taken out, etc. So it's really understanding the fractal nature of the market and, more importantly, order flow. And you combine that with liquidity. So how we use liquidity is where we take our profits at, and how a lot of retail have been programmed to read liquidity is in such a way where they want to put their stop losses there. And so that is the difference between retail trading and SMT trading, where you're actually trading in alignment with those banks. Now, the market is always building forms of liquidity, right? Because not only has it gone and taken this trend line liquidity as the price trend down, well, for a future point, and this is how the algo is programmed, for some future point, we are going to see the clear out of this liquidity, and as price goes back up to clear out this liquidity, you will understand that price will have built more liquidity. And so this market really is just a concept of institutional liquidity inducement. Once you understand that, you really have an edge over the market. Thank you guys for joining me in this video. I hope you guys did enjoy.